Hello and welcome to the PolicyBazaar Show with me, Chaiti Narura. This is where we put the spotlight on insurance every week and bring the wisdom of all experts for you viewers so that you can make the right choices. Now see, the pandemic has affected businesses across various sectors, rendering markets volatile. Historically, we have seen markets gaining a good upswing as the situation normalizes and businesses boom again. This, you have to understand, takes time, and we'll only get to know about it once we're on the other end of unlocked tunnel. Until then, what do we as consumers need to do is the question. We have already established in one of our previous episodes how this might just be the right time to invest in insurance. The only question is how. How to understand the market, the current trends, and choose the right product. That brings us to our topic of the day: choosing the right investment product in times of market volatility. Joining me today to discuss more on this, we have Srinivasan Parthasarathy, the Chief and Appointed Actuary, HDFC Life Insurance Company Limited. He's a leader in the insurance industry with over 25 years of experience across life, health and pensions, both in India and the UK. Srinivasan, an actuary by profession, has strong business mindset, successfully driving businesses to achieve conflicting top line and bottom line objectives within a robust risk management framework. Welcome to the show, Srinivasan. Pleasure having you today with us on the PolicyBazaar Show.
Thank you. Thank you.
And joining him in this discussion, we've got Santosh Agarwal, Chief Business Officer, Life Insurance, PolicyBazaar.com. Santosh joined PolicyBazaar.com in 2011 as an Assistant Manager, Business Development. Today, under her leadership, the life insurance vertical has witnessed a major transformation in terms of market share and product innovation. Her performance has been remarkable, particularly in driving the term insurance business, helping PolicyBazaar.com acquire 50% share in the online term insurance market. Santosh is joining us for the second time. Welcome to the show, Santosh. What a pleasure having you again today with us.
Thank you so much.
Let's start today's discussion. My first question is to Srinivasan. Srinivasan, even as the COVID pandemic continues to spread across the globe at a dizzying pace, is this the right time for people to invest their money as the stock market remains open for business?
You know, the great American investing legend, Peter Lynch, once said, more people have lost money waiting for corrections than in the actual corrections itself. So, trying to predict the markets is not a great idea. But having said that, of late, the market conditions have been turbulent. And, during such conditions, fear factor does dominate people's minds than logic. The VIX index, you can call it a measure of the fear in the markets, had actually jumped up to as high as 80% in March. Although it has now come down to around 25% levels, the long-term average, you can say, is around 50 to 20% levels. So there is some, bouncing back of confidence in the markets. And, while the markets have actually recovered to pre-COVID levels, it is still disjointed with the broader economy. So no one can really be sure, when the recovery is going to pan out. But as investors, we should keep certain basic things in mind. One should have adequate term insurance and health cover for the family. You should have about, say, 6 months income in liquid assets as an emergency fund. And once you've done these two, if you have additional resources, then you should consider investing, keeping your financial needs and time horizon in mind. Invest as much as possible in a regular, disciplined manner rather than investing in one lump sum so that you can spread the risks. And also, you should invest in a diversified portfolio of asset classes rather than putting everything in one basket. And once you've actually selected a portfolio of assets, all you have to do is to stay calm and stick to the plan, regardless of the volatility that you see in the markets.
Over to you, Santosh. Now, keeping in mind the current pandemic situation, what customer buying trends are you witnessing? Which investment products, according to you, are they most interested in, and what are they currently looking for when investing their money?
What we've seen when we see customers investing their money, and if what we analyze pre-COVID and what's changed post-COVID, the interesting trend that's emerged is that pre-COVID, a lot of people were wanting to invest in market-linked products. And equity was a lot of, I think, gathered a lot of interest over the last couple of years, given the returns have been phenomenal. What started happening after COVID was, customers were became just risk averse, because obviously there was volatility that was expected with the ongoing situation. And what we saw was, the moment we talked about fixed income products, or products that had fixed rate of interest, and where the capital was protected, and at any point in time, whatever money the customer invested, that at least was secure with an upside of market. If that proposition was pitched to the customer, the interest was far higher. What basically it means is that the customer today is okay with a slightly muted return, but at least wants a guaranteed sort of a return. And that's what has changed, I would say, with COVID coming in.
Srinivasan, what are some of the current evolving trends and investment patterns that you're observing at this point? How were they different pre-COVID, and now how are they different? I mean, we can't really say post-COVID because we're still in the middle of the pandemic.
Absolutely. During such hard times, what we've seen is household savings go up significantly. In fact, recently the European Central Bank published a report that showed that household savings actually increased by 5 percentage points from the earlier 12.5% to 17.5%. Of course, this is still low compared to Indian standards, but it just gives a trend that pre-COVID and post-COVID, the household savings have actually gone up. And similar trends we've observed in other countries as well. And this is quite understandable why this happens because of two factors. One is forced savings, meaning that people other expenditure actually come down. For example, they would have spent on a holiday, or just doing other usual stuff that is not there during lockdown. The second factor that increases the saving rate is precautionary savings, due to fear of, say, loss of employment and, other uncertainties associated with it.
Sure.
So when people save more, generally they keep it in their bank accounts or in other liquid instruments like FDs, or like Santosh said, they do invest in guaranteed products.
Absolutely.
And guaranteed products in insurance industry is actually picked up in the last, say, 1 year or so. And a similar trend we've seen in mutual fund industry as well. In fact, the recent AMFI report says that equity mutual funds have suffered an outflow for the third straight month in a row, probably indicating profit booking by investors. And like I said, in insurance industry, amongst the private companies at least, there has been a significant drop in people investing in ULIPs. So pre-COVID levels, it was about 44% of the portfolio was in ULIP, and now it has come down to 30% levels. And we've seen a corresponding increase in the traditional savings. And when I say traditional, it includes both the non-participating as well as participating products. So that's what we are seeing in the insurance industry.
So Santosh, when you're looking for guaranteed returns on the investment side, most people often look upon bank fixed deposits. It's always a safe haven, from years together, you are known to make those fixed deposits aside once your salary hits your account for some. However, very few people know that FDs do really come with their own set of drawbacks, and they're not suggested for investment for a longer term duration. In fact, even the percentage on the ROI has really gone down now these days. The interest levels have dropped significantly. Can you also elaborate on some of these drawbacks of investing in a bank FD?
The biggest drawback is that the profit that you make is taxable, and that's taxable as per the income tax slab.
Yes.
The other disadvantage, I would say, when it comes to a fixed deposit is that if you invest, say, for 5 years today, the maturity you will get after 5 years. If you invest again next year, you will get it again after the 5 years. So it'll be rolling return. So basically, you will not get lump sum at any one time. So if I have, say, money to invest, and I can invest, say, 1 lakh rupees every year, and I start investing today. So I invest this year, next year, and year after. So over the next 5 years, I will be investing 1 lakh rupees each. The FD will mature on the 6th year, on the 7th year, on the 8th year, on the 9th year, and the 10th year, right? So every year, one of my FDs will mature, which means I will not get money at one go. So if the objective of the investment was, a goal like, maybe buying a car, that kind of can't be really met, because you're getting the return every year, because one FD will mature every year. So those are, I would say, the cons.
But what in case of the compounded interest? Is there any upside to it?
Yeah, so the interest is quarterly compounded. That's the benefit when it comes to an FD. And the other benefit when it comes to an FD, it's easy. That one just logs in into their net banking account, and at the click of a button, you can book your FD, you can liquidate it. So those are, I think, the benefits of investing in an FD. But if you were to take slightly more effort and invest in products, like the insurance products, the guaranteed products that we have, the benefit that you get here is a huge tax arbitrage. So there is absolutely no tax that you will need to pay. So most of these products, you will have the option to invest, say, for 5 years, and at the end of 10 years, you will get your money back, or you can invest for 10 years, and at the end of 20 years, or at the end of 15 years is when these products will return you your money.
Okay.
So there is a lock-in, period that exists. But the advantage of, imagine getting a 5.3% return or a 5% return for that matter over 20 years, right? In a bank FD, the maximum that you can lock your money in for is for 10 years. And there the return is 5.4. Promising or giving a 5.3% rate for 20 years, I think that's phenomenal. And I think that too tax-free is the icing on the cake.
That's amazing to know. And I'm sure our viewers are listening and getting the right insight as well, because not many people know this as well. Now, I'd like to address this to Srinivasan now. Broadly, most guaranteed investment products are divided under two major categories: participating and non-participating products. Would you be able to elaborate on both these product categories and how they are really different from each other?
See, under non-participating products, the benefits are fully guaranteed to the customer at the outset. Whereas in participating products, the benefits are partially guaranteed. There is a discretionary component of the benefits called bonuses that would be paid depending on the performance of the fund. So on the one hand, you have unit-linked products that are completely market-driven, while on the other, you have non-par products that are completely guaranteed. And participating products lie somewhere in between ULIPs and non-par products. So the key advantage, if you see from participating products, is that they offer, in a way, the best of both worlds. The upside potential through some equity exposure, while at the same time having the downside protection in the form of a minimum guarantee. And all these products have sufficient life cover, at least 10x of the premium one pays. And therefore, you get that 1010D exemption that Santosh referred to.
That's right. Well, it's time now for a very short commercial break here on the PolicyBazaar Show. Stay tuned. We're going to be learning more about non-participating products with our guests on the PolicyBazaar Show. Welcome back. Thanks for staying with us on India Today. You're watching the PolicyBazaar Show with me, Chaiti Narula, and our guest, Srinivasan Parthasarathy from HDFC Life Insurance Company Limited and Santosh Agarwal from PolicyBazaar.com. Today we're discussing choosing the right investment product in times of market volatility. Santosh, before the break, we learned about the differences between participating and non-participating categories. Now, what are some specific features that make non-participating products better for investment in comparison with the participating products? Also, if you can please list some of the prominent non-participating investment products that one may really choose to invest in.
So, see, non-participating is where the rate of interest is completely guaranteed, and it is promised to you upfront. So you know what is the amount of money you'll be walking away with at the end of the investment period. And that is, knowing that and having that certainty, I think is important to a section of investors. Participating, on the other hand, have a bonus component, and that bonus component is dependent on performance of the insurance company that you're taking the product from. So you may take participating products if you've chosen a company that you believe is going to perform in the next 10-15 years, and if there is a decent history of performance in the past, then there is a very minimal risk that you are taking. But again, there is some risk because it is dependent, or the bonus is dependent on performance. So I think that is, so the capital amount of premium that you invest, that is mostly guaranteed. So that amount of money is something that will always come back to you. And the profit that you make will come through bonuses that a company will declare. I think some of the good products that today on the guaranteed non-participating side are one of the, I think, path-making products was introduced by HDFC Life, which is Sanchay. And there's a version of Sanchay now called Sanchay Plus, where the rate of return is almost is 5%. And this is, again, completely tax-free. And you have options, to take your money either in a lump sum format or in an income format. And there's a whole life income format also that you can kind of take. There's another product from Aditya Birla called Guaranteed Milestone Plan. That's again a very good product. The rate of return there is close to about 5.3%. Again, tax-free. There is a product from Bajaj called Gold Suraksha, which is a good product also. There's a product from ICICI Prudential called a short savings. So all of these are in the 4.8 to 5% kind of a range of interest and completely tax-free.
Absolutely. Srinivasan, it is often said that non-participating products are specifically for those who have a longer investment horizon. Are these trends around what age group of people invest the most in non-participating products, and what is the most common investment tenure according to you?
Yes, it is right to say that non-par investment products are generally more appropriate for longer investment horizon. And in non-par category, you have products that offer guaranteed lump sum benefits. And you also have products that offer an income benefit beyond the term of the product. And income benefits we've seen are generally preferred by people who are closer to retirement. In fact, annuity products are actually a subset of the non-par category of products. And when you look at our non-par Sanchay Plus product that Santosh referred to, the average age of the customers we see are in the mid-30s, or 30, 35, 36 is what we are seeing. And the tenure of the investment is for around 30 years. But generally, people prefer an income, so they have to pay premium for, say, 6 years, 8 years, 10 or 12. There are 4 options. And they get income for the next, say, 12 years to 15 years. So generally, we see around 30 years is the total term of the products, and whereas age is in the mid-30s. Whereas if you see annuity products, you see the average age being in the late 50s. So in our portfolio, the annuity plans average age is 59 years, since it's more sort of suited for those nearing retirement.
Right. Santosh, let's come to you on annuity plans. What features make annuity plans better than any other retirement solution?
This is protection for you till you live. So there are, I think, 2 products that are key, I think, important aspects of financial planning for any customer. One is term insurance, which ensures that your family, if something were to happen to you, your family is taken care of through the benefit, that benefit that you receive through your insurance product, which is basically planning, for the short term. Till your retirement, if something happened, term insurance takes care of you. But after you retire and till you live, you take care of yourself through a pension, and that is taken care by annuity products. It gives you a pension till you live, and that's the risk the insurance company is taking. That if you were to buy an annuity product and you start getting your pension from 60, even if you live till, say, 100 years, a guaranteed pension will be given to you. So for anybody who's in non-government jobs and do not have a pension coming in from your employment, annuity is one product that you should take, which will ensure that you are providing for yourself, and you're providing for yourself till you live. So I think that makes annuity very important as part of our financial planning. And this is the best way for you to secure yourself.
Right. Coming to Mr. Srinivasan now, continuing about annuity plans from where Santosh really left off. Are these products specifically designed to meet the retirement needs of the customers? And who should look at buying these annuities?
Yes, I would agree that annuity plans are the most appropriate product to meet the retirement needs of the customers. See, the biggest risk that an individual faces post-retirement is actually outliving his savings. So imagine he doesn't buy an annuity product and he puts his retirement corpus in a, say, savings account or an FD, and starts drawing down the savings. So there is a risk that he actually draws down the savings too fast and then end up running out of money in the later years. So here, the annuity products, the income is guaranteed to the policyholder as long as he's alive. So even if he, say, lives for, say, 100 years, he'll get the same income. So all the future, uncertainty regarding interest rates
Yes.
are eliminated in this product. So, then who should buy this product? Anyone who is already, say, retired or closing in on his retirement, should purchase annuities. And usually the trend has been that people purchase annuities at retirement around the age of, say, 60 years. But what we have been doing is trying to encourage people to start the retirement planning a little earlier while they're still working, so that they can lock into the current yields and remove the risk of yields falling at the time of retirement. So, for example, you may be accumulating a corpus for your retirement at 60, and say you're say 50 years old. But while yes, you can accumulate a corpus for 60, but what if the interest rates at the time you retire at 60 is actually very low? So therefore, what we've done is we've come up with a new product. It's not very new. It's been there for a couple of years now. It's called deferred annuities. So this is aimed at people who are still in service, and they are, say, in the last 10 years to retirement. And instead of accumulating their corpus in a pension plan, they might put that in this deferred annuities and lock into the prevailing yields. So it has two advantages. One is since he's coming in earlier, the annuity rate would be much higher. For example, if the immediate annuity rate are around 7%, you will be getting around 10 or 11% guaranteed annuity rate, say 10 years before retirement. So that is the advantage. And we have been, and this product has actually picked up pretty well in our company. So, but all in all, the annuity products are ideally suited for someone who's planning for his retirement.
All right, thank you so much. Those were some really valuable insights and closing remarks. Well, that's all that we have for you this week. Thank you so much, Srinivasan Parthasarathy and Santosh Agarwal, for joining us today. Keep watching the Policy Bazaar Show. This is Chaiti Narula signing off.